Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. China's former Ministry of Railways for years was one of the country's most bloated and inefficient of government agencies. That's why in March of last year, Beijing broke up the group and announced that the private sector would be allowed to invest with the hopes of increased efficiency and a way out of chronic debt. Analyst with GK Dragonomics in Beijing, Rosalie Yao, writes in a recent report how private investors could be interested in a sector long plagued by bureaucracy, corruption, and debt, despite hundreds of billions of dollars in government transfers. Statistics from the National Audit Office show that the new national railway operator was bogged down in debt of 2.9 trillion yuan, or about $500 billion in June of last year, while its total assets were valued at around $770 billion. Factories have been moving away from the higher-cost coastal region and into China's western areas, which should be good for rail freight traffic. But this uptick is balanced by the slower growth of coal being transported by rail, as well as a better network of roadways. Freight traffic over rails fell in 2012 and recorded only a slight uptick last year. Yao says over the past several months, Beijing has rolled out important reforms to ease some of rail's woes. One involves pricing and how firms are charged. Previously, middlemen took under-the-table charges and railways received little for carrying cargo. These so-called agent fees could add another 20 to 40% in surcharges and even higher in times of peak demand. This has changed, so rail operators should now receive more revenue and customers don't see their bills rise too much. Professor at Beijing Jiaotong University and railway expert Li Hongchang says the primary goal for the company is to increase revenues and cut costs. Li says to raise freight rates is a natural solution. Others do recommend more substantial price hikes of up to 38%, but Yao says such an increase would place a huge load on rail's industrial customers. China Railway Corporation, or CRC, which was spun off from the former ministry, says they may raise freight rates from about 2 U.S. cents to 2.5 cents per ton per kilometer, which they say is, quote, more reasonable. There's also the possibility of adding more dynamic pricing to take advantage of swings in market demand, which would be a radical departure of the previous dual-track state-imposed pricing. As Yao describes, the CRC is trying to distance itself from its scandal-plagued and inefficient predecessor. The group issued a new unified pricing schedule, is taking orders online, and cut processing times, which had caused long waits. All this contributed to road freight taking away rail's once dominant share of the market. China's rail transport volume is the largest in the world, accounting for 25% of the global total. But only 2% of containers are sent by rail, compared to 30 to 50% in the U.S., Japan, and Western Europe, so there's still plenty of room for growth. China is expected to spend over $100 billion on railway construction this year alone, and another $65 billion on building subways in the country's cities. So with all this government money lying on the tracks, where is there room for private investment? Yao says the area where investors could see the best returns are where reforms take away the monopoly position of logistics subsidiaries of the dissolved ministry. CRC has turned the on-rail assets of these subsidiaries into more like independent service providers, which should change their incentives to better serve customers and shareholders. Yao believes these moves have the potential to bring profits to investors and, at the very least, will make things more interesting. Yao points out that these reforms come from the same playbook China has used to overhaul other state monopolies. The GK Dragonomics analyst says by rationalizing prices and increasing competition, supply, service, and financial returns all end up increasing and on track to please customers and investors. You're watching Biz Wire on the Blue Ocean Network, China's first and only privately owned English-language broadcast media. Our full episode can be seen on our website, BONTV/biz-wire. In just a moment, we'll continue with more insight into the big picture of China's economy.